Often people get stuck in basics so much that they can't move on and make the final call. We have seen some similar situations on the internet about EPF and PPF as well. It has been a topic of discussion and differentiation amongst most of the youngsters. So today, we thought, let's make it clear and simple for all of them. So in this video, I will be discussing about EPF, PPF and the major differences and benefits. But before that, subscribe to H&R Block India to uncover many more secrets like how to save money, make smart investments and the best income tax saving shortcuts. Now that you have subscribed to our channel, let's get started. EPF, which is widely known as PF, is a government-established saving scheme for those in employment. To be eligible to invest, you must work in a company which is registered under the EPF Act, and you and your employer have to contribute 12% of your salary and the earner's allowance every month till you are employed. On the other hand, PPF is a government-supported savings scheme. It is open to each and every citizen of India, which means it is not mandatory and anyone, literally anyone, can contribute Rs 500 to 1,50,000 per year. It has a fixed rate of return which is set by the government every quarter. PPF account can be opened with any authorized bank or post office. For more details, you can visit the post office website, State Bank of India website. You will find these links in the description below as well. Let's look at the most basic differences between EPF and PPF. Eligibility to invest. Any Indian except for NRI can invest in PPF. On the other hand, you can have an EPF account only if you are an employee of a company registered under the EPF Act. Investment amount. You can invest from Rs 500 to Rs 1,50,000. However, for EPF, you will have to compulsorily contribute 10 to 12% of your salary. It can be increased voluntarily but not decreased. Tenure. It has to be 15 years, after which it is extendable for a block of 5 years indefinitely. For EPF, it can be closed while quitting job permanently. Also, it can be transferred while changing companies till retirement. However, there is no minimum blocking period. Rate of interest as of April 2019. For PPF, it is 8% and for EPF, it is 8.65%. Contributor to fund. You can invest in PPF directly, and if you are a minor, your parent can do it for you. For EPF, however, you and your employer both will have to contribute in it if your company is registered under EPF Act, which means unemployed or minor cannot avail it. Tax benefit, the most important one. Your contribution in PPF is tax deductible under Section 80C. The maturity amount is also tax-free. Your own contribution is tax deductible under 80C, and your employer's contribution are exempt up to 12% of your salary. And the maturity amount is tax-free only on continuous service of 5 years. Let's talk about liquidity, which means how easily you can take your money out. EPF is more liquid than PPF. You can withdraw 75% of your money if you have been unemployed for more than 1 month, and all of it for 2 or more months of unemployment. However, if you withdraw your money before 5 years of continuous contribution, it will be taxable. In case of PPF, you cannot withdraw the money due to unemployment till a term of 15 years. You can make partial withdrawals after 6 years. However, these partial withdrawals are capped. The maximum amount per financial year is the lowest of 50% of the account balance as at the end of the financial year preceding the current year, or 50% of the account balance as at the end of the 4th financial year preceding the current year. You also have a choice of taking a loan against your PPF account balance from the 3rd to the 6th year after account opening. The loan amount can be a maximum of 25% of the balance at the end of the 2nd financial year preceding the year in which the loan was taken. EPF withdrawal becomes taxable if you withdraw them before 5 years of continuous service. On the other hand, PPF withdrawal is not taxable at all. Investment in EPF qualifies for tax deductions under the Section 80C of the Income Tax Act, which is up to Rs 1,50,000 per annum. Interest on EPF is also tax exempted unless you become unemployed. Withdrawals from EPF are also free from tax unless you make them within 5 years of opening the EPF account. If the withdrawal amount before the completion of 5 years of continuous service is more than 50,000, then TDS will be deducted. TDS can be avoided by filing the Form 15G or 15H if your income is less than the basic exemption limit. The investment in PPF account up to 1,50,000 per annum gets you a tax reduction under the Section 80C of the Income Tax Act 1961. The interest and the PPF maturity amount are exempt from tax. In order to get the best tax deduction and accurate tax preparation, you should visit our website. Go to Income Tax Services, where you will find income tax e-filing by experts, and let H&R Block's in-house team of tax experts prepare and file your tax returns online. There we have it, guys. All confusions about EPF and PPF clarified. I hope you loved it, and I would really appreciate it if you could drop in your comments below on what you would like us to cover next, and we will make our videos based on your suggestions. If you like the way we explain the differences between EPF and PPF, please like this video and share the same with your friends and family. Subscribe to H&R Block India by clicking the red button below to get information about personal finance, GST and saving taxes. And when in doubt, always remember, tax se mat daro, H&R Block ke saath chalo.